Everyone believes the AI bubble is mainly about stocks, and that makes sense. The obvious historical comparison is the dot com era. However, this one is all about credit, unlike 1999. And that credit is now talking loudly through credit default swaps and other debt market signals. Companies like Oracle and SpaceX have seen their CDS prices surge recently, with big moves in July across all the big names in AI tech. Amazon, Meta, negative cash flow for the first time, Google, Alphabet, whatever the company.
Credit default swaps is basically insurance on bonds. If you buy a bond and you're worried that the other side is going to default on that bond, you buy a credit default swap, and that protects you. If there's default on the bond you own and you have a swap, the swap pays you back instead, and you don't lose anything. So that's what a credit default swap is. And they're a way people also bet on, like someone's going to default. You buy lots of these, even if you don't own the bonds, or if you think a company is really stable and won't default, you might sell them.
Calls itself Nvidia. They're seeing higher premiums as well. Even BlackRock trying to sell an AI-linked bond. Similar results to what we talked about with Amazon's bond offering. The debt problem is spreading and deepening as the debt cycle turns more and more. Back in the dot-com days, investors assigned extraordinary valuations to technology companies based on profits expected years into the future. And today, once again, investors are questioning whether sky-high expectations will match reality. Semiconductor stocks are falling. The NASDAQ 100 flirting with correction territory. Even companies reporting record profits are being punished because the results.
And a surge in oil prices would pop this bubble. Pop!
Can't keep up with the enormous expectations surrounding AI. And increasingly, investors are no longer just asking how far can these companies grow. Instead, they're asking, how do I protect?
And imagine Trump heading into the midterms with surging oil prices, surging gas prices, and collapsing stock market. Yeah, it won't be good for Republicans.
Myself, if they're wrong. The stock bubble that everyone is expecting to find in valuations is instead showing up in the availability and price of money itself. For the first stage of the AI boom, the largest technology companies appeared capable of financing almost everything themselves. Amazon, Microsoft, Meta, Alphabet, Oracle, they all generated enormous revenue, in most cases substantial operating cash flows. They also possess some of the strongest credit profiles in corporate America. But the scale of the build-out and the uncompromising, almost religious way every one of these CEOs has embraced the tech future, it has changed the equation. AI-related debt issuance reportedly reached $270 billion by early July 2026, which was already close to twice the amount issued during all of 2025. Amazon, the same list. Alphabet, Microsoft, Oracle, Meta, they accounted for approximately $194 billion of that total. These companies aren't borrowing because their ordinary businesses have stopped working. They're borrowing because even their tremendous cash flows are being overwhelmed by the sheer cost of competing. Each company believes it must build immediately because falling behind in the AI race could be, in their view, fatal. But when every company reaches the same conclusion, they all compete for the same chips, electricity, construction capacity, and capital. The AI race, therefore, becomes a financing race, and a lot of that spending isn't going to fuel winning. It is fueling expensive, eventual losing. And in credit markets, the winner is not necessarily the company with the most exciting technology. It's the company that can eventually generate enough dependable cash to support everything it borrowed to build. The dot-com comparison is useful, but as critics contend, it's often misleading.
So if AI ends up being less profitable, all companies that borrowed tons of money to finance AI will be in trouble.
Then you could just add .com to your name and the stock market would take it from there. You get equity capital despite having little revenue and no viable route to profitability. Today, the largest AI spenders are completely different. Amazon, Google, Meta, the same list we keep coming back to. They're all profitable global businesses with valuable assets and huge already existing customer bases. That's why many people are rejecting the bubble comparison, and they're not entirely wrong to do so. But a bubble doesn't require the underlying technology to be fake. The internet was revolutionary. Fiber optic networks were useful. E-commerce.
Yeah, that's why I think the AI is real. It's going to have real impact. I absolutely agree with that. But just like the internet bubble, It's overvalued now. It's there's been too much money put in compared to what the technology can produce in the short term.
Eventually transformed the world. The problem was the price paid and when it was paid, the capacity and overcapacity being built, and eventually what really brought it down, the assumptions that were used to justify everything. The same distinction applies to AI. Artificial intelligence can be historically important while investments made in its name still produce terrible returns. Every data center doesn't become profitable merely because AI adoption grows. Every chip order doesn't generate sufficient revenue. And every company doesn't win
That's
simply
party like it's 1999. That's a cushion.
because the total market gets bigger. The relevant question is no longer whether AI will matter, it's going to. It's whether the incremental revenue from AI will cover the incremental cost of building and financing it. Costs, by the way, that have absolutely blown out here in 2026. That is where the debt market enters the story. Stocks price the dream. Credit asks whether the dream can make the payments. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be in today's video, and now let's get back to it. And the clearest indication of this changing mindset comes from credit default swaps, CDS. The old market that we once talked about back in the 2008 crisis.
Yep, they were big in 2008 crisis because people were selling them on the toxic subprime mortgage CDOs, bundles of toxic debt. People were selling credit default swaps on that, and yeah, there was all types of chaos because of it.
Well, it's back at the forefront, at least here in July 2026. A credit default swap, or CDS, functions somewhat like insurance against a borrower failing to repay its debt. A buyer pays an annual premium to a protection seller, and if a defined credit event occurs, the contract provides compensation. The higher the premium, the more expensive it is to obtain protection. And that's really the signal, not necessarily default or default probability, but the demand for protection among investors. Oracle's CDS spread reached approximately 215 basis points this week, up from about 145 basis points at the end of last year. And this is the highest it's seen in several years. SpaceX, that's a big one. Its swaps reached approximately 185 basis points, rising by more than half since trading began just last month. CDS contracts tied to NVIDIA, Meta, Amazon, Alphabet, all the same names we keep coming back to, they have also reached new highs, though at lower levels than Oracle, SpaceX, and another one, CoreWeave. These numbers aren't a forecast that default is imminent. The direction, however, it's significant, as is the big name.
If the cost of insuring debt, that means if more and more people are thinking someone might default, it also means the cost for these companies of borrowing is going up because the two are correlated. Because if you're more worried about a company defaulting, you demand higher interest rates.
Names that are on the list. A year ago, the main concern surrounding a high-profile AI-related debt offering would have been securing an allocation. The dominant questions were growth and yield. With SpaceX, dealers were circulating prices for 5-year default protection before the bond offering had even been formally announced. Investors wanted a hedge before there were bonds to hedge. That is a huge behavioral change. The conversation is shifting from how much can I buy to how do I protect myself? A credit cycle doesn't flip only when companies default. It begins to shift when lenders stop assuming everything will work and start charging for the possibility, the growing possibility that it won't.
That's how the U.S. basically Ponzi scheme financial system works. If you control the media, you influence the herd, financial herd. And so you can sell the right type of derivatives. You can buy credit default swaps in a company you know is going to be into trouble because you're covering up all the stories about that company running into trouble ahead of time. You know, for example, oil market's going to explode and right now and go to the moon because you've been covering up the oil shortage, the looming oil shortage for 4 or 5 months. So you know it's going to go to the moon, and so you buy the right type of derivatives to profit off that. And that's the profits from that are what allow the U.S. financial system to keep operating despite being essentially a Ponzi scheme or a bucket shop. That means somewhere that you buy the oil trading ETF, like UFO and UTO, UTO, oil ETF name. USO, sorry, USO. If you buy USO, none of that money ends up in actual oil. It goes into the futures market, it goes into paper oil. So if you have more oil than there is in existence, this UFO tracks more oil than there is in existence right now. What happens if oil skyrockets? How would the people on the other side of that contracts ever make good on that under normal situations? It just doesn't work. They'd go bankrupt. The only way a market like that doesn't have any correlation with the underlying asset works is if through huge market manipulation and profiting from derivatives.
And this growing caution is emerging because AI adoption can be interpreted in two very significant ways. Millions of people use generative AI. Businesses are experimenting out the wazoo with co-pilots, coding tools, search assistants, automated customer service, and a whole bunch more. The usage is real, and the technology does continue to improve. But usage, it's not the same as profitable usage. Many AI services are offered for free, at least currently. They're bundled into existing subscriptions or priced below the full cost of providing them.
Only time I use AI is through Google Shirts and once in a blue moon asking Grok something is because it's pretty much free. If I had to pay for it, I wouldn't use it.
Inference requires computing power every time a user generates an image, processes a document, or asks the model a question. And that creates a potential problem that didn't exist in the same form for traditional software. Once conventional software was built, serving an additional customer could be extremely cheap. With generative AI, each additional customer can bring continuing infrastructure costs. And the industry is betting those costs will decline rapidly as adoption will become deeply embedded and companies will eventually obtain substantial pricing power. And maybe they will, but cheaper.
There's so many AI companies. It's so competitive. And when there's so many choices on where you can get your AI, it puts the power in the hands of the customer.
Models, especially from China, are challenging the assumption that the most expensive model necessarily creates the strongest competitive advantage. If comparable performance can be achieved with a lot less computing power, today's massive infrastructure plans could prove excessive. The adoption projections may be broadly correct, while the revenue estimates are still wrong, especially if, as we're seeing now, users balk at keeping up their AI spending, while not especially if.
As token maxing dies out, Silicon Valley is having second thoughts. Yeah, because now the AI companies, in order to actually make money, are trying to charge more for using it, and companies are balking.
As we're seeing now, users balk at keeping up their AI spending while not getting the productivity return they signed up for. That's exactly the kind of uncertainty credit markets are built to price. And the credit default swap market, it's not acting in isolation here. I talked last week about the Amazon bond sale. There was another one with BlackRock. A lot of it is all the same thing from different angles. As we talked about, Amazon sold $25 billion worth of bonds across 8 tranches with maturities ranging from 3 to 40 years. And initially, the orders reached approximately $62 billion. But after the banks managing the offering reduced the spreads offered to investors, orders fell to roughly $41 billion. That left demand at only slightly more than 1.5 times the amount of bonds available. Now, for an ordinary borrower, that might have been perfectly acceptable. But for Amazon, it was remarkably weak. High-grade U.S. bond offerings have typically attracted orders around 4 times their size just this year. Amazon also had to provide an elevated new issue concession, with some of its longest bonds reportedly offering an additional 18 to 21 basis points relative to comparable existing debt. So Amazon got its bond through. That wasn't the warning. The warning was that investors required more compensation and provided
higher interest rates.
Much less enthusiastic demand than the market.
Makes borrowing more expensive. And that's not a good time for AI companies to have higher interest rates because they're under pressure already to earn enough to produce returns. So you have higher interest rates costs, it's even harder for AI to become profitable.
Market had come to expect, suggesting something has changed. Then came a $12.5 billion data center bond offering arranged through BlackRock entities. The bonds financed BlackRock's stake in a Texas data center project being developed for Meta. The offering took nearly a week and encountered weaker than expected demand, just like Amazon's did. And it ultimately priced at a yield of 7.53%, which is one of the highest yields for a blue chip data center financing since the current AI borrowing binge began. This is huge. Again, the bonds got sold, but credit stress first appears not as a locked door, but as a higher price for walking through it. And after all that, with the bond
Eventually, for once there's enough panic in the market, it'll become impossible for these AI companies to borrow at all.
market stress starting to show up and bond markets uneasiness, consider what's going on with Google or Alphabet, the negative free cash flow for the first time in the company's history, emblematic of exactly all these concerns that we keep seeing in the marketplace. That negative free cash flow was $5.9 billion, the first since Google became public in 2004. Again, this is not a solvency crisis. Google, Alphabet, however you want to call it, remains enormously profitable in its advertising, its cloud, YouTube, obviously, the Android business. They all remain extremely valuable.
But now they have this AI subdivision added onto them and is adding costs to all those profitable divisions and pushing the company into negative cash flow.
The free cash flow measures what remains after operating expenses and capital expenditures. And in the last quarter, Alphabet spending consumed more cash than the company generated because of AI and this religious drive to win the race. When capital expenditures reached $45 billion, which is approximately twice the amount from a year earlier, that's saying something. And then Alphabet raised its 2026 capital spending budget to between $195 billion and $205 billion, with management warning they expect spending to rise significantly again in 2027. It's getting to be a lot for a lot
Google is burning through cash with spiraling AI costs.
of uncertainty. It's a staggering estimate for a single company. And more importantly, spending twice as much doesn't necessarily mean Google is building twice as much
Meanwhile, its search results become more and more trash.
capacity. Memory prices are rising, power connections are scarce, transformers, turbines, other equipment, they all have long waiting lists. Suitable land is disappearing and becoming more expensive. All the same companies are bidding for many of the same resources, driving up their costs far in excess of what was expected when the budgets were put together. And part of that increase reflecting inflation is not a proportional increase in computing power and therefore revenue generation down the road. So Google, for example, faces two risks: whether AI generates enough revenue and whether each new dollar of investment buys less infrastructure than the previous one. That's how the equity story becomes a credit and debt story. And then there are the accounting issues, because let's face it, when you have this
Always. Same thing in 2008. Hiding the losses.
much of a spending bill to finance in the debt market, there's a huge interest to be creative about how that debt shows up, or in many cases doesn't show up. And it's another thing for the market to worry about. What is the true cost, the cost today as well as future cost of this AI tech build out? Oh yeah, they're experimenting with structures that are designed to prevent all this debt from appearing directly on their balance sheets. And again, last year, nobody cared.
This is interesting.
This year, people are finally starting to poke around and ask the right questions. The Texas project,
And the reason they could get away with it for a full year is because we don't have a functioning media that would call it out like month one.
financed by BlackRock, provides a clear example of this. BlackRock entities hold approximately 80% of the project's equity and finance part of that interest by selling $12.5 billion of bonds that we just talked about. Meta retains roughly 20% of the exposure and guarantees lease payments connected to the project. Now, technically, much of the debt belongs to the project structure rather than Meta itself. Economically, the data center still depends heavily on Meta. Now, this doesn't necessarily mean it's something's wrong or unethical here. Project financing is common and can allocate risks efficiently. But as structures become more complicated, investors are finding it harder to determine where the ultimate exposure sits. And in many cases, it is by design. Banks financing these projects can use credit derivatives to reduce or hedge their exposure, which means rising CDS activity may reveal anxiety that isn't obvious from corporate balance sheets alone. That's what we're getting here. That's the big signal from the credit default swap market. The market is no longer financing only a handful of technology companies. It is financing those plus special purpose vehicles, infrastructure partnerships, data center developers,
Huge
power
credit
projects,
bubble.
chip suppliers, all of it tied to the same underlying assumptions. If AI revenue grows as projected, all of these structures will pay off and they'll work really well. If adoption disappoints, if pricing power weakens, or if the technology becomes much more efficient, the industry could discover it financed too much capacity at precisely the wrong price. The debt doesn't eliminate that risk, it redistributes it, and that's what
Blue Owl. Blue Owl is a huge private credit company. The hedge funds put their money in to invest in stuff. It's going to be a big part of the next financial crisis.
where everybody is interested right now. If this doesn't work,
Blue Owl.
who actually would be holding the bag? And of course, there's already indications that many investors, even the stock market, are reconsidering a lot of their previous assumptions. The tech stocks, especially semiconductors, they have not had a good month here in July. The MSCI World Semiconductor Index fell 16% in July, putting it on course for its worst month since 2022, though we should point out it remains substantially higher for the year. The NASDAQ 100 moved toward correction territory as semiconductor shares, they fell across South Korea, Japan, Taiwan, and of course the US. SK Hynix reported a six-fold increase in quarterly profit just recently and margins that were above 80% and promptly saw its shares fall 19%. Why would investors punish results like these? Because the expectations are even higher. SK Hynix, good example, announced at least $31 billion in capital spending for the year, approximately 50% above its previous level. What looked like evidence of extraordinary demand could also be interpreted as another supplier dramatically expanding capacity near the top of a cycle when it's most expensive. At the same time, reported Chinese progress in advanced lithography increases fears of future competition and excess global chip-making capacity. This is the dot-com resemblance that actually matters. At the peak of a capital cycle, record profits encourage record investment. Record investment increases supply. Increased supply eventually pressures prices and returns. The best financial results often arrive just before investors begin asking whether those results can possibly be repeated and sustained.
Yeah.
Everyone is watching AI stocks for the bubble, but stocks, they tell us what investors hope companies might become. Debt tells us what investors believe they can safely finance. Right now, Oracle's protection cost is at a multi-year high. SpaceX swaps have surged. Amazon encountered unusually weak bond demand. A BlackRock-backed data center financing required a 7.53% yield. And Google's unprecedented negative cash flow demonstrates just how quickly AI spending can overwhelm even the world's most powerful cash-generating businesses. None of these signals individually proves there's some impending crisis. Together, though, what they do show increasingly clearly is that the market has started recalculating risk, especially the debt market. The AI boom is no longer a contest about who can spend the most and grow the fastest. It's fast becoming instead about who can deliver on the promises and who will be left holding the bag when inevitably some of those promises, maybe a lot of those promises, don't live up to the projections. The economy moves through four distinct regimes, and each one rewards a completely different portfolio strategy.
All right. That was an interesting video. The AI bubble is running into trouble. The fact that credit default swaps, the costs of those are increasing, it's a signal. It's the same way as the 2008 financial crisis started. The credit default swaps on toxic mortgage securities went up too. Add an energy shock and a recession caused by that. Yeah, I'm thinking the AI bubble is going to burst sooner rather than later. Anyway, this will be on YouTube. Like and subscribe. Come watch and kick our Twitch, and I'll see you next video. Bye.